Bonsoir à toutes et à tous. Merci d'être ici si nombreux pour la première Investment Conference de la CFA Society France. Cet événement va être co-présenté. Donc moi, je suis Pierre BISMUTH. Je suis membre du conseil d'administration de la CFA Society France. Et nous allons co-présenter l'événement avec Margarita Lugo, qui est dans la vraie vie gérante chez Arvela Investments. Dans une première partie, nous allons avoir le plaisir d'accueillir Paul Jackson, le Global Head of Asset Allocation de Invesco, qui va nous faire un panorama et essayer de dresser en fait le futur, les 25 prochaines années de la gestion d'actifs, puisque, comme vous le savez peut-être, cette année, le CFA Society France a 25 ans, et donc c'est voilà, un quart de siècle que nous allons fêter tout au long de cette année. Et ensuite, nous allons vous convier avec d'autres panélistes, dont Paul, à un comité d'allocation d'actifs. Le but de la conférence sera que vous ressortiez avec une allocation d'actifs stratégique pour l'année 2024. Tout de suite, je laisse la place à Paul Jackson pour sa présentation. Merci Paul.
OK, merci Pierre, bonsoir tout le monde. Comme d'habitude, ça fait plaisir de revenir à Paris, mais je dois avouer que cette fois-ci, j'ai une petite déception. J'attendais échapper la flotte britannique et je vois que, voilà, j'ai retrouvé la flotte française. Quelqu'un m'a dit que vous avez, pour passer le CFA, vous avez tous étudié en anglais. Donc je me dis, chouette, je vais faire la présentation en anglais. Parce que, pour dire la vérité, je fais des présentations en français, normalement à Paris, mais je ne veux pas, après une journée assez fatigante, je ne veux pas vous faire souffrir mon français exécrable. So, I'm going to switch to English, if that is okay.
That's okay.
Thank you. So, 25 years of the CFA in France. I'm going to talk a little bit about the last 25 years, looking and using stock market indices to talk about some of the things that have happened during that time. And then I'm going to focus more on the future and looking at the next 25 years. And actually, I'm not going to stop there. I'm going to have a look towards the end of the century and what I think returns on investment may be over that time horizon. But to start with, let's have a bit of history. Ooh. So here we have three stock market indices: the NASDAQ, S&P 500, and the CAC 40. Starting in December 1997, because the CFA, la Société CFA française, je crois que c'était en 98 que ça a démarré. So we start in December 97, and as we can see, we have a number of historic events that have marked the last 25 years. I'm sure you have many historic events of your own, but let's go back to the very early period, and of course, this was the period of the dot-com bubble. We also had other things. We had 9/11, the trade Twin Towers in New York. We had the birth of the euro. So there was a lot going on in this period. Does anybody recognize this? J6M? Jean-Marie Messier, moi-même, maître du monde. Voilà. And the reason that I've included this reference here is because When you look at the market performance here, of course, the NASDAQ had quite a nice bubble, and then deflation of a bubble. But actually, if you look at the CAC 40, the green line, it actually did quite well, and better than the S&P 500. And one of the reasons, I think, is because there were companies like Vivendi that were changing what they were doing and kind of got involved in this drive towards technology and media. So actually quite surprising looking back that that French stocks did so well at that time. Then we move on a little bit, and what do we have here? Well, we have another sort of bubble. It wasn't quite as dramatic, but there was the housing bubble, yes, in the United States, but pretty much everywhere. There was a housing bubble in the early 2000s. I was living in Paris at the time, and prices were moving quite nicely here, London, Dublin, wherever you were. House prices were doing very well. Bank stocks were highly favored. Yes, there was a time when bank stocks were highly favored. And it wasn't unusual for bank stocks to be selling on a price-to-book value ratio of 3, 3 or 4. If you go to the period after the financial crisis, it was 0.3 and 0.4. It was a very different environment. But at that time, we had this housing bubble and a bank bubble, which, of course, we know how that finished with the financial crisis. But look here at the stock market performance. The CAC 40 leading the way. Since the beginning of 1998, the CAC 40 has outperformed the S&P 500, outperformed NASDAQ, and it was only really once we got through the financial crisis and then we hit the Greek crisis and the Eurozone crisis that things started to go wrong for European equities. And since then it's been one-way traffic. The NASDAQ has exploded. S&P 500, with some concentration in growth stocks and technology stocks, has done quite well. But poor old European indices, the CAC 40 included, really just chugging along and not performing that well. And there's this idea of the old continent that really doesn't have any dynamism. I think that was shown in this relative stock market performance. It's quite interesting, of course. Here we have some quite dramatic events. We've had a global pandemic. I've never seen that in my life. I don't think anybody in here had, unless I'm much mistaken. We had really dramatic policy loosening, and then inflation and policy tightening. We had Russia invading Ukraine, so war in Europe. So there's a lot going on in this period, and some quite dramatic. Of course, this is not on a logarithmic scale, so it probably looks more exaggerated than it really was, but nonetheless, some pretty dramatic movements in stock markets. But at the end of the day, the ranking is very clear, and I want you to keep this in your mind because I'll come back to it in the last slide. NASDAQ, S&P 500, CAC 40. So you may be feeling a little bit, you've kind of missed out. Europe has been missing out on what's been going on across the Atlantic. But of course, looking at this from a stock market perspective, technology stocks have done really well. So you would imagine that technology has been a big driving force for economies, that we must have had lots of productivity gains, deploying all of this technology. We've had very strong economic growth, but this really is just a stock market phenomenon. It's not really something that has translated into benefit to the broader economy. This first chart is showing GDP per capita So it's income per capita across Sweden. It goes back to 1700, so across Sweden, the pink line. The UK is the dark blue line, and the US is the light blue line. And of course, as that line goes up, GDP per capita is increasing. It's one measure of productivity. It's how much economic income is being generated per person, and you would expect that to increase over time. And really, since and these are all set at 100 in 1929. Since that period, they've pretty much matched each other. What's really interesting from this chart, though, or one of the interesting things, is that Sweden is actually higher than the US. I'm not surprised it's higher than the UK, but higher than the US if we set them all equal in 1929. But the other thing about this chart is this flattening out. There is definitely a loss of momentum in terms of productivity growth, in terms of income per capita growth. And you see that quite dramatically in this chart, which is looking at US productivity growth. And it's basically based on 10-year rolling averages. It's annualized numbers, but on a 10-year rolling average basis. Well, remember what we saw a moment ago. Tech stocks going gangbusters. Somebody making a lot of money out of technology. Of course, it's the owners of the technology and those who are investing in it. But the broad economy has not been getting so much of a benefit, which is quite, it's quite interesting and quite disappointing that productivity growth is now so low, despite everything that the stock market is telling us. But there is maybe a bit of hope. I always quote Led Zeppelin in my presentations, and I don't know, any fans of Led Zeppelin in the audience? I made the mistake of asking that question in Bangkok one time, and it was a very young audience, and when I said, okay, any fans of Led Zeppelin? Nothing. Who's heard of Led Zeppelin? Nothing. So you always have to judge your audience, which was a good lesson. But in The Song Remains the Same, the film about the concert, or a series of concerts, in introducing Stairway to Heaven, Robert Plant says, this is a song of hope. And so this is a chart of hope, which is that if you, this is looking at US economic growth. So this is value-added growth. So it is basically like GDP growth is this line, and it is made up of total factor productivity growth. So this dark blue bar is productivity growth. And at the time of the dot-com bubble, so at the time of the birth of this society, productivity growth increased. Now, I'm not necessarily convinced the two things will. I don't mean that the CFA society had nothing to do with productivity. I mean that the dot-com bubble, I'm not convinced that the dot-com bubble was doing this, but I'm willing to go along with that notion. So if you believe that the dot-com bubble led to this increase in productivity, and these are now 5-year rolling annualized changes. If we believe that that was linked to technology, then look where we are now. Oh my goodness, such low productivity growth. But if we assume something similar to this as a result of artificial intelligence, one of the ideas is it's going to increase productivity. When we project forward, and we basically just take the average growth in that period, and we project it forward, you get this uplift in economic growth. And that has a lot of implications. Number one, if you've got more economic growth, you would real economic growth coming from productivity, you would imagine that it would be good for equities or assets that rely on growth. Might not be so good for bonds, because usually I would imagine that over the long term that real interest rates are linked to underlying economic growth or trend economic growth. So if you boost the trend growth, you maybe boost real yields, which would push down the bond prices. So it's probably better news for equities than it would be for bonds, for example, over the coming decades. May not be if real yields go up, and Thibault, please block your ears. If real bond yields go up, it might not be so good for something like gold, for example. But, you know, that gives us some hope. We would get more growth with less inflation. And this is maybe one of the things, it's one of the hopes for 2024, that it could give us that kind of, the idea of a soft landing. But of course, there is also fear in here, which is that a lot of jobs are going to disappear. But what I would say is that always happens. This shows the US labor market going back to 1940. It makes a comparison between 1940 and 2018. It is showing the share of employment by types of job and industry. So if you look in 1940, the farming sector, the farming and mining sector, accounted for a large share of jobs in the US, and production likewise. But by the time we get to 2018, farming, there's a lot of jobs that have disappeared there. Farming's a much smaller share than it was, as is production. And by the way, the light blue line, sorry, the light blue bar shows you the jobs that existed in 1940 that still existed in 2018. The middle blue bar shows you the jobs that existed in that didn't exist in 1940, but that existed in 2018. So these are new jobs. The two taken together are the share of employment in 2018. But as you can see, there are wrenching changes across the labor market. Lots of jobs have disappeared in that time. I can think when I first started writing research, I used to have an assistant. I would write it longhand. She would type it out, leave spaces for me to then go and create a chart that I would print off. And we used to cut and paste. It used to mean something real. We would cut it with scissors and then paste it onto the piece of paper where she had left the space. Then it would go off. When it was finished, it would be sent off to a printer. The printer would print the thing out overnight, hard copies, and then it would be couriered around the world. All of that has disappeared. I just write it in Word and send it out by email. And nevertheless, you know, those are jobs that I can see that have disappeared. And despite these wrenching changes, we've still got record low levels of unemployment. We always find something else to spend our money on, and some, you know, it may seem an extravagant waste of money, but we always find something to spend the money on, and we always find new activities. So I'm not so concerned that we're going to see lots of people lose jobs. I think we will see changes. There may be some frictional unemployment, but I don't think it's going to lead to anything long-term in terms of much higher unemployment. But of course, when you invest in the stock market, what you really are looking for is a bubble. Who doesn't like a bubble if you're in there? Even Warren Buffett, I believe, had a bumper sticker which said, "Oh Lord, please just give me one more bubble." And artificial intelligence is an obvious place where you could see a bubble coming from. It's got a lot of the ingredients. It's new. We don't really know a great deal about it. And that's fertile territory for making up anything that you want. So analysts and strategists will try to come up with the most aggressive forecasts about what this means, about what earnings are going to be, what revenues are going to be from companies involved in this, what it may mean for the economy at large. But the one thing that we don't have, and then prices go up, and then my wife criticizes me for not being invested. She calls me a fool. The guy next door has made a fortune out of artificial intelligence. You should be. So I jump on it, and then somebody else sees me make it, and then we all jump on. We like to be part of the herd. We don't like to be isolated. And that's where bubbles come from. But there is a critical ingredient missing at the moment, and that is the ample supply of credit. I look at bubbles going back to the South Sea bubble, and I've got a template that looks at 15 financial manias. And there's usually a big supply of credit in the background. Think about 3 years ago when we had the crypto bubble. Central banks at that time, well, governments were putting a lot of money in our pockets, helped by central banks, and that meant we had money to burn. In the words of my father, we had more money than sense. So that's where you get bubbles from. There's lots of money. The latest idea then becomes very popular. Bang, off it goes on an exponential trend. At some stage, once the credit spigot gets turned back on, then it could become a bigger thing. But for the moment, I think it's probably going to be relatively contained. And I don't think we will see a credit cycle like we saw in 1920 and 21. But I was talking about the NASDAQ and how it's been a big stock market phenomenon. The returns on tech stocks have been very impressive. But a lot of it is kind of what I would call technology that isn't necessarily really helping us. It's sort of very superficial stuff. How big are you going to make the number 5 on a keyboard of a telephone? Is not really helping the world. We do need a lot of help in terms of climate change. And what I'm showing here is technological evolution in a sort of climate change setting. This is showing the CO2 intensity of GDP. So it is the amount of CO2 included or required to produce each dollar of GDP in low-income countries, high-income countries, and middle-income countries. These are the ones that are industrializing, that do most of the production in the world, places like China. And this is the global average. And you see that those curves are coming down over time. Technological advances are allowing us to be less CO2 intensive, which is good. We need more of that. So we need much more of this sort of technology. And if we assume that these trends continue, this is my projection for what will happen in terms of global temperature change. By the end of the century, we will have something close to 4 degrees of temperature change. Forget 1.5 degrees. It's something much more than that is already baked in. But we need to skew these curves downward. And I think there's going to be a lot of investment taking place to try and skew these curves downward. But even if we double the rate of decline in CO2 intensity, we still end up on my temperature change model with this sort of temperature change by the end of the century, which is just above 3 degrees. So it's a massive challenge. We're going to need lots of mitigation investment spending, but also lots of adaptation spending, because we're not going to succeed in limiting temperature change to a level that is going to keep things comfortable for everybody in the world. But I said I would look to the end of the century. These are my return projections to the end of the century. It's a little bit old. I did this in 2019, so these fixed income returns will be higher now because bond yields have gone up. But the point is that looking over the long term, it's going to look something very similar to what it has looked like historically, where you get reward for taking risks. So things like stocks and REITs do better than things like government bonds and investment grade. And that is even though I've pulled these down from historical levels because of things like dealing with climate change, because of demographic factors, they will all reduce economic growth, which I think will reduce these returns. But when you put all of this through an optimizer, it basically tells you to focus on cash, fantastic diversifier, and REITs and stocks. But when you're focusing on real estate, make sure you're not buying real estate in coastal areas. Now, this is my last slide. I said I would come back to the relative performance of the CAC 40 versus NASDAQ. Here, the darker blue line is showing you the CAC 40 divided by the NASDAQ. When it's coming down, the NASDAQ is outperforming the CAC. And it's a sad story, but this has kind of like been the story of the last 25 years. But there is another trend in there that is very important. The light blue line is the US 10-year Treasury yield. And that's also, for most of this period, been trending down. And this relationship makes perfect sense. When bond yields come down, the discount factor on that you apply to future income flows comes down. And mathematically, if you go through the maths of it, the premium that you should be willing to pay for higher growth goes up. The lower that bond yields are, the higher the premium you pay for growth. So it makes sense that when bond yields were trending down, that the NASDAQ would continue to outperform the CAC. But actually, something's changed here. All of a sudden, bond yields have gone back to something more normal. This was an aberration down here. This, I think, is much more normal. And we can see it's like a bit like a tanker turning around, but I think it will continue to turn around, and I think there is hope in there for indices other than the NASDAQ, that with bond yields staying up at these sorts of levels, I think that growth stocks, it's no longer a one-way bet. These growth stocks, I think, are actually quite expensive. And the time of the CAC 40 may be ahead of us. I think it's going to be a much more balanced picture between those two indices than it has been for the last 25 years. Now, the only thing I've got, I think I've got a minute left. I've just got to read through these notes and disclaimers. So there we go. Well, thank you very much for your attention.